Welcome to another episode of Million Dollar Stories, where we get to interview authors all over the world. As you guys know, I talk a lot about financial literacy. And if you can understand maybe the origins of banking, maybe you can understand money. And if you can understand money, you can maybe understand how to obtain freedom. And I think what Elon Musk posted today is so relevant to the topic that we're going to be going over. He posted on X, these scam coins are getting crazy. Someone shilled me 27 trillion in circulation, unlimited supply cap, only one node, 25% of supply minted in the last 6 months, and 1% of holders own 30%. Just kidding, guys. That's the US dollar. so, so that is so relevant to this topic because the book we're going over is called Fragile by Design: The Political Origins of Banking Crises and Scarce Credit. We have the author today, Charles Calomiris. Thanks so much for being here, sir.
It's a pleasure to be here.
Well, let's start off with the genesis of this book. When I first saw it, I thought to myself, wow, this kind of reminds me of the creature from Jekyll Island. And I see on the picture of the book, it is a house of cards. And that is exactly how I look at the US dollar. So what made you want to write this book?
Well, that's a great question. I rarely get asked that question. Well, Steve Haber, and my co-author, and I were looking for an opportunity to do something together. He's in the political science department at Stanford. I was in the finance department at Columbia Business School. But we're both trained as economic historians, and we both have an interest in financial history. And so honestly, it was conversations between the two of us as part of a working group of scholars who were all writing books together, it turned out. So it was one of those really interesting things. It's never happened any other time in my life, which is that somebody just decided to convene a group of people, and you would probably recognize the names of most of the people in that group, and just kind of try to figure out what are important topics that we should be working on. And I want to emphasize, I won't go on and on, but just to say, a lot of academic work, including some of mine, tends to kind of be small ball, doing stuff on fairly narrow kind of conceived topics. So what was interesting is the Hoover Institution Working Group kind of said, well, let's elevate that and think about big topics and think about what you could do at a book length and make it a collaboration. And several pretty excellent books came out of that working group, and this was one of them.
The first question that you ask in section 1 of the book, it looks like, is if stable and efficient banks are such a good idea, why are they so rare? And I'd like to start off with maybe that answer if you can.
Oh, well, of course, that's a great place to start because the technology for stable and efficient banking was established in Scotland by the middle of the 18th century. And it's not rocket science. So if you think about a standard bank, it funds itself with some kind of money-like debts, typically, for the most part, as well as the equity contributed by the partners or the stockholders of the bank. So that's what funds the bank. That's what gives it its resources. And then on the other side, it's holding some cash as its assets, but the rest of its assets are typically loans, sometimes some bonds thrown in there. But so if you think about the standard traditional commercial banking enterprise, it's doing some pretty simple stuff. And that stuff has been done in some form or another since really like the 7th century BC in Athens. So it's not like this technology is very complicated. In conceptual terms, it's not. You're taking in some liabilities. You might give me a deposit. I tell you, you can come get it when you need it, Mike. I'm the banker. And by the way, I'm going to use that deposit to fund lending to people here in the community. And I'm going to be holding some cash and making some loans on the asset side. And I'm also putting my own equity in as the owner of the bank. And that's it. So all I have to do is figure out how to manage some risks that come from that activity. There's some problems. One of them is How do I make you feel comfortable about putting your money in the bank? That's a pretty difficult thing to manage, and keeping your money in the bank. And
Hmm.
so when we were thinking about this, we thought, a lot of academics look at this and say, oh, this is impossible. This is impossible. Nobody can do this, because you have to convince Mike to leave his money here, no matter what kind of things he sees happening in the world, to convince him that he shouldn't take his money out suddenly. You have to somehow convey to him, even though he's a radio personality, you're the banker, but you have to somehow convey to him enough information so that he's comfortable with you. How in the hell does that happen? And then you have to figure out how to get the people you lend the money to give it back to you after they borrow it. So you might say, well, we take this for granted, but a lot of academics working on this issue have said, wow, this is really hard. They sometimes formalize it. They call it the delegated monitoring problem. How do you convince people to give money to somebody to do secret things with it? And
Yeah.
and right, so it's not, even though it seems like it's a pretty simple technology, it's kind of challenging, and a lot of academics have kind of puzzled over it. And part of the reason that they've been puzzling over it so much is because they're coming from the US or graduate training in the US, which is one of the most unstable banking systems in all of human history. And so many academics come to this topic kind of assuming that banking is inherently unstable. But that's wrong. That's just US banking, and a few other countries in the world have very unstable banking systems. But through most of world history, let's go back to 1750 in Scotland, when they first kind of perfected this technology. By the way, they had lines of credit, they had clearinghouses for exchanging the notes of the banks so that they could efficiently manage clearings. They had just about everything that you could imagine, and they had a very stable and efficient banking system. They paid interest also on deposits. So all the things that we think of as kind of standard commercial banking was perfected by the middle of the 18th century in Scotland. Also branch banking, the whole thing. So they didn't have an unstable banking system. Canada, our northern neighbor, has never had a banking crisis.
Wow.
And they started chartering banks in the second decade of the 19th century. So that's 200 years now, more than 200 years. And they've never had a banking crisis. And so the US has had, depending on how you count, let's just use a rough round number, like more than 20. So that's kind of an interesting thing, because these two economies look similar in a lot of ways. And here's the other funny thing. The Canadian economy has been more volatile than the US economy throughout that period, because Canada is more of a primary commodity producing economy. So GDP in Canada is a little more volatile than the US. So I love to start with that. Why is it so hard, given that the basic technology was developed and perfected really by the middle of the 18th century, and that we have examples of other countries that have managed to have very stable banking systems. So banking crises are clearly not inherent in the simple technology of banking, even though you might, as many academics, they say, oh, this technology is it's so complicated, must be prone to banking crises. But then if you look outside your own borders a little bit, and you look back in time a little bit, you find it's quite the opposite, that the US has kind of been as unstable as Chad or the Democratic Republic of Congo or Argentina. And that's not the club that you want to be in, but that's the club that we're in historically over the past 100, 200 years. And that's kind of, an interesting question. Why is it so hard, given that this technology has been around for 300 years almost in a perfected form? And given that so many other countries that have a lot in common with us managed to have a very stable banking system, why is it the US, but then other countries too, just don't seem to be able to get it?
So I've interviewed many people when it comes to, let's just say, the 1800s. There was one guy who talked about the silver standard. There was actually a battle between the gold standard and the silver standard, and I think it was
Yes.
Colorado or Utah, somewhere in there. And the race was on, I guess, at the late 1800s, early 1900s, and then eventually the gold standard pretty much won. I guess the minds of most people. So 1913 happens, the Federal Reserve is created. How do you view, I guess you could say, the 1880s up until about 1913?
Mhm.
Is that where the banking crisis really started to take form and how it became almost like play money the moment the Federal Reserve was created?
Well, the Federal Reserve's creation was part of a bargain, a political bargain that had been in place really from about the 1830s on and had been associated with banking instability throughout that period. So, and that bargain changes, you could say, a little bit in the night in when the Fed's created, and then it changes again over time. Big changes in the 1980s and 1990s. But
Yep.
let me go back to that initial bargain that the Fed's own creation was part of. And that was a bargain that had to do with who had the power over bank chartering and the powers of banks and what would be banking. And that really was, at that time, notice this has changed since then, but at that time it was agrarian interests. The US was primarily an agricultural economy, and also under federalism in our Constitution, much of the power, and in fact, the bank chartering power in particular, resided in the states. And so, starting in 1863, I could go back farther, but let's just stay there. As part of the Civil War, the national government also started chartering banks. But I think it's better to start a little earlier and say, so in Canada, which we've already mentioned, the chartering of banks was done on a nationwide basis. So Canadian banks operated throughout the country. In the US, that wasn't the case. The states controlled bank chartering, and even the nationally chartered banks could only operate under the same rules as the state banks, which meant that they also operated one location. So imagine a banking system. Because of federalism and because of the way things were set up in the laws at that time, a banking system where all the banks operated pretty much one location, whether they were chartered by the states or chartered by the national government. And so sometimes you had like 25,000 banks at one point in the US.
Hmm.
And so that's a really crazy way to set up a banking system because it makes the banks very unstable. They are very undiversified. If you are a bank in Champaign-Urbana, Illinois, you're basically, all the risk has to do with the price of soybeans and the price of corn.
Yeah.
And no matter whether you're lending to a farmer or somebody who works as a laborer in the town, the risk is still soybeans and corn, if you understand what I'm saying. That's the local economy. So that's
Yeah, and
very
so real quick,
undiversified.
I just want to touch on that. Yeah, these local banks rely on the local economy because typically, if you look at a bank as just a business, the way they make their money by lending it out, and if there's no growth, if there's nobody buying, if there's nobody
Yeah.
creating any type of wealth around that area, that bank is going to implode and potentially lose people's money. There will be no belief in it. So, yeah, that's the system. And I guess, I mean,
And,
whenever you
and
talk,
if they and if the price of soybeans goes down, just as you said,
people
there'll be
leave.
no belief. People
Yep.
will want their money back, and there'll be problems. And so we had the most unstable banking system in the world for a lot of this time because the people who were in control of the bank chartering policy actually didn't want banks to operate in another way. They wanted their bank to only have the chance of operating locally. And I could go through the explanation for this at great length, but the best way to kind of understand it is that by restricting your banker to only operate locally, that did create some benefit for you in some situations. For example, if soybean prices fell 10%, instead of the banker moving all the money out of lending to soybean farmers, he would had really no other option. He could either buy government bonds or lend to soybean farmers. So in order to keep his profits up, he'd still keep lending to soybean farmers. But then if prices of soybeans fell 40%, you're both done, right? The soybean farmer's going to be bankrupt, but then also the bank that's lending only loans based on soybeans risk is also going to be done. And so when I modeled this, that is, tried to think about what's driving the politics of this, that was really the key, I think, is that local businesses felt like they got a little bit of credit insurance. They could be sure that the bank wouldn't pull the rug out from under them if they had a little bit of a problem. So they kept it that way. And this was a big deal. Like William Jennings Bryan, who ran for president several times toward the end of the 19th century, this was one of the three main planks of the Democrat Party platform in those days. That is the prohibition of allowing banks to operate outside of one location. It was a very big deal. In an agrarian economy, this really mattered. And so when the Fed was created, to finally get to your question, I'm sorry it took so long.
That's right.
When the Fed was created, at that time, there were still lots of restrictions on loans that could be collateralized by real estate. And it's a complicated story, but roughly speaking, the agrarian interests went along with the creation of the Fed only on the condition that the Fed's rules would be that it would lend against, to some extent, agricultural real estate loan collateral. And that was a part of the change that allowed the Fed. So what's really interesting is the political compromise of the Fed was quite complicated, but the agrarian populace had a very strong influence. And that was the beginning of the expansion through regulation of allowing banks to lend more and more in real estate. And if you fast forward through this whole period, but to today, a banking system that used to prohibit real estate collateral, this was commercial and industrial banking, wasn't supposed to be real estate banking. Now, almost every bank, on average, leaving out the four largest banks, the rest of the banking system, 75% of its loans are collateralized by real estate. And for the largest four banks, 50%. So I think the real interesting story has been how instability throughout that period in the banking system was mainly the result of the fragmented structure of the banking system, and increasingly the result of allowing banks, this is starting in the 1930s especially, allowing banks to take on more and more real estate risk, which is very correlated with the business cycle. So if you create this kind of incentive for real estate risk, which you could see was very politically popular, governments decided to charter banks to do this because it was popular. So, I like to tell people who, ask me, whose fault is it that the American banking system was so unstable? And say, well, look in the mirror. That's whose fault it is.
Wow.
Because you reward politicians for doing things that make the banking system unstable. We love to blame politicians. I'm in the same game. But if you really look at the politics of where bad regulation comes from, even the most recent crisis that we just had last year, I think I could point to many aspects where people, even though they're very critical and should be critical of the Federal Reserve's horrible policies, which have been so instrumental in causing this banking crisis in 2023, both monetary policy, because they have power both on the side of monetary policy, but they also have power on the side of bank regulatory and supervisory policy. They're very much to blame, no question. But, these regulators and politicians are just a straw. We live in a democracy. If people would spend more time on podcasts like this,
yep,
and get energized about this topic, and then look in the mirror and ask themselves some hard questions, like, are you rewarding politicians for doing things that make the banking system unstable. A great example of this is deposit insurance. Many of your listeners are going to say, well, deposit insurance, I like that. I like knowing that my deposits are insured by the federal government.
Up
But
to
then,
250. Is that right?
yeah, right. But if you ask the question, what's the economics literature unanimous about? Now, you guys are used to hearing that economists disagree about everything. Guess what we're unanimous about? We're unanimous about the proposition that deposit insurance destabilizes the banking system.
Wow.
Because,
I didn't know that.
yeah, because once you protect bankers from the discipline that comes from the possibility that depositors might get worried, bankers become very lax in their risk management. And so this is like the number one reason for banking instability around the world today is the excessive protection of banks by the government. And so this is but if you told, I'm sure a lot of your listeners are saying, hey, wait a minute, I like federal deposit insurance. And then if they had to tell a story about where it came from, they'd say, well, FDR created federal deposit insurance. Now, here's another one for them to chew on. FDR knew that deposit insurance was destabilizing. He wrote a letter during the presidential election of 1932. He wrote a letter to the New York Sun saying, if you have deposit insurance, it takes away the incentive of depositors to be careful, which takes away the incentive of bankers to manage their risk. Why was he so smart? Because 8 states' banking systems had collapsed in the late 1920s, exactly as a result of their experimentation with state-level deposit insurance. And Roosevelt was pretty smart. So he actually campaigned against the idea of federal deposit insurance. But then once he became president, he wanted to get something that he wanted to accomplish done. And the only way he could do it was by allowing Henry Stigall of Alabama to get his way. He was the chair of the House Banking Committee, to get his way by installing federal deposit insurance. Henry Stigall from Alabama wanted his small individual banks to be protected by it. And so it's like, there's a history here. And if you look at it, once they installed deposit insurance, people kind of said, well, this sounds good. I really like having individuals like having deposit insurance, but they don't necessarily see that this has been the most destabilizing aspect of the US. I'll give you another example relating to that. Prior to 1934, nobody would have been crazy enough to think that you'd want to have withdrawable deposits as the main funding source for banks issuing 30-year fixed-rate mortgages. That didn't exist. Mortgages were like 5 years. They were mainly held by insurance companies or these old intermediaries that were called building and loan associations. Nothing like a savings and loan.
Wait, when did that change? What year did that change?
1934.
34, they went from 5 or 10 year loans to 30?
Yeah. So what happened was...
I didn't know that either.
Yeah, 3 things changed. So we had a single act in 1934 that created Fannie Mae. It created the FHA to help poorer people get mortgage insurance, and it created the thrift charter with deposit insurance. And by creating deposit insurance, you take the incentives away of depositors to be concerned. So you can issue anything. So they allowed them to do 30-year fixed rate mortgages. And then, of course, you may recall we had a banking crisis in the savings loan industry in the 1980s, one of the largest and biggest crises we've ever had. But when you look at that and say, well, gee, what were they thinking? Given that when interest rates changed, it destroyed the value of all their mortgages, and all these thrifts went insolvent. What were they thinking, allowing thrifts to fund long-term mortgages with short-term debt? Because that's inherently a bad idea. And the answer is they were thinking that it would be politically beneficial to somebody to tell them that mortgage credit was going to be cheaper, and that they could make it cheaper by insuring the deposits of these newly created intermediaries. So almost everything during this period that we were talking about prior to the 1980s is really about preserving this fragmented banking system and using increasingly after the 1930s, using government protection of the banks as a way to put protection on top of them so that they didn't have to manage their risk very well. So we didn't have any banking crises until the 1980s, after the 1930s, because deposit insurance put sort of a Band-Aid on things. But so it's kind of, there's a complicated series of things, but until the 1980s, that's kind of the story. And then in the 1980s, things change because when we get that crisis and other banking crises, they shake things up a little bit. There are other things that are changing too. A lot of people have moved out of agricultural areas. And so the new political bargain is now going to be primarily an urban coalition that's in charge of things. And now it's all going to be about mortgages in urban areas for consumers that are driving the bus. And now Fannie Mae and Freddie Mac are very important in there. We have some other things going on. And so it's a long story, but even though the nature of the problem has shifted, we don't have that fragmented banking system that we had back in the 1930s or the 1830s. It's still a political equilibrium. I mean, notice that in 2023, the banks that had problems there were all doing the same kind of nonsense that drove the problems in the savings and loan crisis that I talked about. Whether it was a mismatch of long-term government debt with their short-term deposits, or a mismatch of long-term mortgages with their short-term deposits, or in one case, it was crypto assets. What they were all doing is getting away with taking on lots of really unwise risks through a combination of regulatory accounting that allowed them to pretend that their assets were worth more than they were. That's sometimes called hold to maturity accounting. But basically, it says that you're allowed to create fiction about the value of your assets. And then when people were figured out through public disclosures what was going on, then we had a lot of turmoil because a lot of those banks had grown so quickly and they'd grown based on wholesale deposits. But I would argue that if you hadn't had deposit insurance, even though those banks themselves didn't rely, because they relied so much on fast growing wholesale deposits, they had the four banks that failed had small fractions of their deposits insured. I would say that the creation of deposit insurance systemically has just created a kind of a sleep at the switch problem where people just are no longer really disciplining bankers' risk management, and bankers don't really prioritize risk management. I think a lot of those banks that went under just were mismanaged. The bankers, when you insure deposits, one of the things that you do is you create a kind of culture of bank risk management that doesn't really understand how important these kinds of risks are. So I think, we have a lot of issues right now. We need to all look hard in the mirror and say, are we willing to be part of a movement that would say, hey, we need to really strictly limit the government protection of deposits, and we need to do some other things that bankers don't like to hold them more accountable and to make our regulatory and supervisory practices more disciplining of banks. I was the chief economist at the Office of the Comptroller of the Currency for a year. And I can tell you that the supervisory mistakes of 2023 committed by the Fed and but especially the Fed, but also other supervisors, are systematic. They weren't one-off errors of somebody who missed something. They are that we're using criteria that aren't meaningful. And we lack a kind of urgency when banks are observably weak. If they manage to sort of check boxes that have to do with accounting treatment or other kinds of things, then we give them a pass. So, I would tell your listeners, we're about to experience another banking crisis. Mm-hmm. The 2023 was the tip of the iceberg. There are 600 banks that are either insolvent or on the brink of insolvency today in the US.
Yeah, commercial banking right now, they're feeling the effects. I'm in self-storage, and they were doing a big capital raise, and they held off because there's some things that are happening behind the
Mm.
scenes. It's kind of scary, right? So there's
It's
probably
very
one
scary,
industry. Yeah, so there's going to be one industry probably hurt more than others, and I would think it's maybe the commercial side. Would you disagree,
especially
or do you agree
commercial.
with?
No, no, but commercial real estate is going to be both. So I think commercial real estate is going to be a place where lots of losses are going to be accumulating. And I think that also government bond yields are not going back to where they were in 2022 and before. And so my own view is these banks are insolvent. It's going to be very, very messy. And when the collapse happens, because our banking system tends to specialize so much in real estate funding, then obviously when they have to contract their activity because they're failing and lots of problems are finally being recognized, the place that's going to have the greatest effect is commercial real estate, not so much residential, because Fannie Mae and Freddie Mac, which remain in government conservatorship. By the way, I wonder if your listeners are aware, the two largest real estate lenders in the United States failed in 2008, and they never got out of government conservatorship, which is managing them in their failed state. So it's like, here we are. What a wreck, right? What a train wreck.
Amazing.
And the reason is because there's not a lot of public awareness about the need for this regulatory and supervisory reform. And I know, you were asking about monetary policy too. Of course, that's a train wreck. And the Fed making its mistakes on inflation was very much a precipitating influence for this volatility of the interest rates. They wouldn't have had to go up so much if inflation hadn't gotten out of control. That was both the Biden administration on fiscal side, but also the Fed on the monetary side. And I would describe current Fed leadership as incompetent. And I think that's so we have some serious issues.
This upcoming
But
year, I think 2024 is going to be an absolute year of chaos. I've always been saying that. So I don't know
likely,
what's going to happen in 2025, but this is going to be a wild ride for sure. I do believe the world is having a little bit of hesitation with the U.S. dollar. I'm starting to see or sense maybe a belief in the U.S. dollar is actually decreasing drastically. That's why you see the BRICS conversations start to
yep,
pop up. That's why you see
right.
cryptocurrency starting to become
Mm-hmm.
like a something in our lexicon pretty frequently. So, what do you see out there? Do you believe in the U.S. dollar, the belief in it's going down, and how do you think the cryptocurrency world is going to change all this?
Wow, those are big questions. Let me try to give you a quick sense of my views on that. So first of all, I like to tell people, if you talk to an economist and you ask him his opinion, you probably shouldn't take it very seriously unless he's basing his opinion on something reliable, like gravity or arithmetic. So here's the arithmetic. The arithmetic is the US is running fiscal deficits into expected deficits into eternity of 6% of GDP. And the big problems there that are driving that are three, but mainly Medicare and Social Security, but also the need to continue defense spending, which is a big category. I think everybody knows this. It's not a surprise. We've known it for 20, 30 years that this needs solving. What's the news recently? The news recently is that no one who's running for president is talking about solving this problem.
No.
No one who's running for Senate is talking about solving this problem. To her credit, Nikki Haley was talking about solving this problem. But notice she didn't get nominated. So what does
Probably
that
because
tell you?
she's a total rhino. I don't trust anything she says, even if she's talking about it. That's the way I look at it.
Well, I'm just saying that what we learned from this electoral period was no one who's got currently the nomination of the two parties, and I haven't really checked what RFK Jr. is saying. I will, though. But nobody who has the nomination of the two parties locked up now is really seriously wants to address the problem. Now, if you don't address it, eventually you have to start printing money, because you can't borrow an increase. You can't have the ratio of government bonds to GDP going off to infinity.
Yep.
That does, no one will buy bonds when they can see that happening. So this is called the fiscal dominance problem in monetary economics. It just says something very simple. If you try to run an infinite deficit, you can't. And what happens instead is you start printing money and inflation goes wild. And then, of course, the value of the dollar collapses. So I believe, and I've written an article about this, it was published in the St. Louis Fed Review back a few months ago. I don't think it's really a matter of opinion. Unless we solve this problem, we're going to have a very high inflation. I think people are already starting to get an inkling of it. That's probably part of the reason gold's going up so much. I think the other countries have similar problems because they have similar indebtedness and similar kinds of fiscal problems going forward. I'm not sure that the US dollar relative to the euro or the pound or the yen is going to depreciate so much, because they're all likely to be in the same boat. They have similar entitlement promises that are similarly putting them in a difficult long-term situation. But to answer your question, I do think that we are in a predictable decline in the value of the dollar. It's, again, the result of a political problem, which is the voters don't want to take action and don't want to pressure politicians or reward politicians for committing to take action. And as a member of the generation, I'm 66, so as a member of the generation that's benefiting from this, I want to thank those voters, because they're not going to be able to get, in real terms, the kind of Social Security and Medicare benefits that I'm getting. It doesn't add up. So what's happening right now is, I always say, I don't understand why the XYZ people aren't out there with pitchforks and torches, demanding reform in these areas. And you don't have to get rid of Medicare. You just have to make it less generous and more sustainable. And there's lots of ways to do that. If you act like you have an infinite amount of resources, you are extremely generous to the current generation, but that's going to change. That's just arithmetic. That's going to change. And when it happens, people are going to get very angry about why was it that we allowed 2 or 3 generations of people to get enormous benefits without doing reform, so that we didn't share the pain of reform with the last 2 or 3 generations, which we should have. So it's a real problem. On the crypto side, you asked, how will cryptocurrency develop? So I have a paper I published in the Cato Journal a few years ago, I think it was 2021, predicting that the future of crypto from a currency standpoint was going to be some kind of stable coin currencies. See, I don't think Bitcoin is, or things that are like Bitcoin, are a reasonable substitute for your checking account. Nobody wants a checking account whose value is so volatile.
Right.
But stable coins, if designed properly, could substitute for checking accounts. And eventually, it wouldn't happen overnight. The initial stable coins are still going to be valued in dollars. But eventually, there's a way to think about stable coins that are valued in other things. In fact, even just could be stable if valued only in the coins themselves, using an alternative metric to the dollar if you wanted to. So there's no reason that people have to suffer with inflation if they can use a new kind of stablecoin technology to create a new payment system based on blockchain that allows them just to avoid the mess of the US dollar. So I've been making that argument, but I want to emphasize that it's not about Bitcoin. Bitcoin physically can't handle those kinds of transacting volumes, and it's way too volatile. So we need a new crypto technology. We have it. It's not that difficult to technologically to establish it. I've been involved in some of them. The tricky problem is, I'll tell you what it is. It comes back to, and I guess you're going to guess it. It comes back to politics. Here's why.
Yeah, of course.
To establish a network on blockchain that would work for consumers as a transacting network, you need a big firm kind of lead the way, somebody who already has a network of consumer relationships. Amazon could do it. Facebook could do it. And of course, Facebook tried to do it. Why did they stop doing it? Because the US government told them that they would inflict a world of pain on them if they didn't abandon that project.
Wow.
So that's a fact.
Politics. Unbelievable.
So the point is, eventually we're going to get this, but to establish this requires somebody who's already got some kind of network to be a first mover who kind of pushes and opens the door on this, and then it becomes competitive among all the networks.
It's going to be Elon Musk. What you're saying is probably going to be Elon Musk, huh?
Good guess. Very good guess. And by the way, in case he's watching, call me and I'll explain to you how to do it.
Elon, can you just save this planet, please? You've already changed the world already, so just keep going with whatever you're doing. I like it. You have a new book coming out. I want to make sure we have enough time for you to allude to it. Obviously, it's in writing. You're about 50% of the way through it. So what is that? I think that's a follow-up to this book, which came out in 2015, I think.
Right. It's a different co-author, Matt Jaremski, and I are writing it. And it overlaps with the subject of the prior book, but it expands it. So now it's about all financial crises, not just banking crises. And where, of course, politics features very centrally in the explanation, as you would have already guessed. But we also have some other things going on there. Politics is kind of defined a little more broadly. And so it's going to be the history of financial crises, and the kind of modeling framework that we're going to be using to help organize our thinking is more based on evolutionary biology and based also on how nations compete with each other and how politics is affected not just by domestic political interests, but also by competition among nations. So that's going to be we don't have the title finalized yet, but it's going to be a history of financial crises, taking that into account. But my message to your listeners is, economics does not exist in a vacuum. You can't understand the persistence of bad things based on some kind of economic failure. Markets work great. The problem is that markets depend on government to operate. They depend on government to create property rights, to create the kinds of environment in which markets can flourish. And governments are political animals by construction. And so it shouldn't surprise us that most of the answers to why things keep getting screwed up has to do with politics. But I also want to leave them with the message that look in the mirror, because politics in our country and in democracies doesn't come from the moon. It comes from you.
That's right. Man, I have a phrase here that I live by in this company, and that is think like an entrepreneur. And the moment you do that, you start to understand how everything is connected. You become more self-aware, but also you understand the economy more. You understand politics more. And I never really cared about politics until I had a business. And then you realize how pretty much everything goes back to, the political winds, if you will. So if you could just understand when the winds change and where they're going, you can pretty much see where there's going to be chaos, and where there's chaos, there's opportunity. And that's why you can become a little bit smarter with your decision making if you're just in the know of what's happening. That's why I love this type of topic.
Well, Mike, I couldn't agree more. And in fact, my own personal history is I grew up in an entrepreneur family. My father was a real estate developer, and he's the one who taught me how to think.
Right. Yeah, that mentality, it serves you everywhere you go. So being around entrepreneurs and just learning how they problem solve, you realize that all entrepreneurs get rewarded for solving other people's problems. And so,
Exactly.
if you can articulate a solution, if you have a little bit more of an understanding of the banking industry or the economy in general, you can hold a conversation, and then therefore you can probably be of service to others at a higher level. So interesting.
Amen.
Anyways, your website or social media channel, are you active on any
Not
platform? Are
at the
you active on
moment.
X?
No, I'm not. And if Elon calls me, I promise I'll open an account.
Yeah, I was gonna say, how the heck are you gonna get Elon's attention if you're not on X? Did you see he made a post? Oh, I guess you didn't, but he made a post recently. Within a year, he will be giving up his phone number for good, and you can. The only way to ever get a hold of him is through X. So if you want to talk to him, get
Wow.
on X now.
Okay, that's good to know.
So check out his book, guys. I love the title of it, Fragile by Design, The Political Origins of the Banking Crisis and Scarce Credit. Has over 153 reviews on Amazon. It's definitely resonating. And it was an honor to talk with you, sir. I really appreciate your time today.
Same here, Mike. Thanks. It's been a pleasure.
Remember, guys, $1 million book will lead to $1 million life. Right on.